Hello everyone, and you're watching Bitcoin Bubble news channel. The US bond market can't fall apart all the way. Why? You can make money and buy it. That doesn't take place. People might lose money, but things in other parts of the world are even worse. I don't know where this inflation, this long-term structural magic, the 1970s are coming from. When you have an aging population, low productivity, a fast-paced technological revolution including AI and high debts, it's almost impossible to create sustained inflation. This is why China, Japan, Europe, and the US can't all do it. People have said that the US Federal Reserve's 50 basis point rate cut in September, which was the first rate cut in more than 4 years, is a sign that the central bank is scared. Rate cutting has begun at the Federal Reserve, according to experts, with a 50 basis point cut just 3 times in the last 10 years in 2001 during the dot-com bubble, in 2007 during the Great Financial Crisis, and in 2020 during the COVID-19 spread. There were serious economic downturns after each of these events, which is why many people think that the Fed's decision to start with such a big cut, even though they said the economy was stable, is a sign that trouble is coming for the US economy. This is something that both billionaire investor Chamath Palihapitiya and startup capitalist David Sachs are worried about. They say that the fact that the Fed cut rates by 50 basis points instead of the expected 25 basis points shows that it is getting ready for big problems. Both say that Jerome Powell and other FOMC members may already be in a panic state, even though they are trying to look cool to keep the economy from falling apart. Chamath and Sachs say that the Federal Reserve will probably announce more rate cuts before the end of the year. If fear gets worse in the coming year, the Fed could start printing money in large amounts. Raoul Pal, CEO of Real Vision, doesn't agree. He is sure that people who are afraid of a recession are wrong, because central banks, like the US Federal Reserve, won't let their economies get too hot. They are the only ones who can stop that from happening. The tool they've been using to hurt their economies since the great financial crisis to print too much money. In a recent chat with the Julia LaRose show, Pal talks about his overly optimistic view of the US economy and the world's financial markets. Here are some clips from the interview. If you like this video, please subscribe to the channel and turn on post alerts to get more videos like this. Glad you watched and have fun with the movie. The crypto market often goes crazy. In other words, the value of all crypto on the market right now is about $2 trillion. In 10 to 15 years, it will be at 10 to 15 trillion. That's the return of La La Land. That's crypto though. Cryptocurrency gives you that chance. The Nasdaq has been paying close attention to this. That's why it keeps going. If we get another, the Nasdaq could go up 20% to 50% or even more, we don't know. It's hard to tell, but the gains are huge. The prices of goods will also go up. Also, we'll see, valuable metals have been going up. As the economy grows, all of its parts will do better and stocks will go up. As of now, inflation is not a problem. To pay for their bills, the central banks are lowering interest rates and making more money available. That's a perfect world. There will be a macro summer and a macro autumn. It's pretty much a market paradise. A lot of people want justice for themselves. To say I told you so, they want the system to fall apart. Printing money and causing inflation is not a viable way to run a business. They do not want to see that this 8% debasement means that we are all being charged 8% for a put option on the system, which may not be that bad, but they do not want to see it. Many people who don't invest in technology can't stand the fact that it does better than what was thought to be the best way to invest, which was the value investor, the volatile commodity, deep value, and so on. They still want it to come back even though it hasn't worked for 30 years. They get even more angry. People start to see trends in how the market is moving to figure out when it will crash. It's not likely that markets will crash unless the risk curve is further out. But markets don't fall when business is getting better. When the business cycle slows down, they crash. Now, let's say the ISM goes over 50. At this point in the cycle, it never takes place. There isn't really a good case then. The Fed is now lowering rates. They are putting money into the system. The market is doing well. And all the signs that point to the future are showing that the ISM will start to pick up. That being said, it's hard to say that there is a bubble that will pop. Another thing they don't see is that when they talk about the boom, they look at price earnings and say, see, price earnings keep going up there. It's going crazy expensive. Price and earnings, on the other hand, always go up more than your earnings. Remember the story about your earnings and house prices? So, how much does price earn? It's the share price that is affected by debasement and the earnings of companies that are affected by GDP growth. The everything code says that as we add more liquidity to the system over time, price gains will keep going up because of this dynamic, but people don't get it. That's why they look to the past. Now, all of this has been done before. This isn't something new. This is what they did after WWII. They controlled the yield curve to get the economy going again, and by refinancing their bills, they pretty much grew their way out of it. From about 1948 to 1968, we had the same 4-year schedule. Back then, we had 20 years of it, beginning in 10 weeks. I love the smell of more cowbell in the morning is what he wrote in a recent post on Community X. It's about the third inning, and the everything code is in full swing. Don't forget that markets are 10 weeks behind world liquidity. The new China aid hasn't even shown up on the chart yet, so this was before it was announced today. Another thing that Paul is sure of is that artificial intelligence, AI, and other completely disruptive technologies like robots and energy storage will change the world in the next few years. The CEO of Real Vision says that the upcoming technology revolution will solve the world's huge debt issue. Pal thinks that all central banks need to do is keep printing money until robots and AI can help fix the world's output issues. This is the main reason Pal is so positive about the world's markets, especially cryptocurrencies. Here are some more film clips. The change was macro made all the money in very short amounts of time in terrible markets. Because I know how to play that game, a market like COVID was great for me. You get a lot of money back very quickly. That being said, macro is getting hard. A few big picture chances have come up since 2012, but not many. What did we have after the European debt scare? The price of oil dropped sharply in 2016 and 2015. In the center, the dollar went up a fair amount, but that was it. But stocks did better than everything else. And the macro guys missed that trend. And this is the work I did over COVID when I began to think about how money is losing value and then about the exponential growth of technology and where this is going. And then you realize, oh my God, this is all one thing. We have growing markets which make more money available and send it into technology which moves technology forward. The central bank has taken out the big risks that things could go badly, and technology is changing faster than at any other time in history. All of a sudden, the facts tell you to be positive. In tech and crypto, it tells you that we're in long-term trends. So each low is higher than the last, even though they change a lot. And now that you look back, they've done better than anything. Even though you felt that volatility and thought, why was I so stupid really? I would have done much better if I had just bought Nasdaq when I first started working. But the story about the macro breakdown is so interesting. A lot of people stay away from shops because they are afraid. A lot of people